The stock market hit record highs today, but Bitcoin dropped nearly 6% as investors panic sell. Wednesday, June 3, 2026. Like and subscribe for daily market updates. Today's agenda: the big picture, market snapshot, inflation update, ECB Rate Watch, geopolitical risks, precious metals, crypto correction. Now let's look at the specific numbers for the major indexes. Welcome back to Market Pulse Daily. We are here on Wednesday, June 3, 2026, to talk about a very strange day for investors. On one hand, the stock market is celebrating record-breaking highs. The S&P 500 is up 0.4% and the Nasdaq is up 0.6%. This is the sixth day in a row that these major indexes have made new records. Investors are feeling positive because of the artificial intelligence boom. Companies like Nvidia, Marvell, and Hewlett-Packard Enterprise are leading the charge with strong earnings. However, this stock market rally is happening while the crypto market is in a deep decline. Bitcoin is down 5.97% and Ethereum is down 7.19%. This split in investor mood shows that people are happy with traditional stocks but scared of digital assets. The Federal Reserve is keeping interest rates high at 3.63%. because inflation is still sticky. Core inflation is driven by computer software and accessories, which is pushing the Fed to keep rates elevated. This means the central bank is not ready to cut rates soon. Instead, markets are now pricing in rate cuts for 2027. This creates a difficult environment for growth stocks that rely on cheap borrowed money. The dollar index is range-bound around 99.00, pinned between these conflicting forces. We need to understand why the stock market is rising while crypto is falling. It comes down to how safe investors feel about their money right now. Now let's dig into the inflation data that is keeping the Federal Reserve on hold. Let's take a moment to look at the current prices of the major assets we track. The S&P 500 is trading at 7,610, which is up 0.39% for the day. This index represents 500 of the largest companies in the United States. When this number goes up, it means the overall economy looks healthy to investors. The Nasdaq Composite is at 27,094, up 0.45%. This index is heavily weighted towards technology companies, which explains why it is moving so strongly today. Gold is trading at 4,492, which is up a fraction of a percent. Gold is a safe haven asset that investors buy when they are worried about the economy. Even though gold is up slightly, it is not the star of the show today. Oil, specifically crude oil, is at 95.05, up 1.38%. Oil prices are rising because of tensions in the Middle East. The dollar index is at 99.29, up a fraction of a percent. The dollar is staying strong because the Federal Reserve is keeping interest rates high. The 10-year Treasury yield is at 4.46%, down 0.45%. This yield represents the return on government debt. When yields go down, it usually means investors are willing to pay more for bonds. These numbers tell us that the stock market is very positive, but the dollar is strong and oil is expensive. Investors need to watch these levels closely to see if the rally can continue. Now let's look at the European Central Bank and their rate decision. The biggest reason the Federal Reserve is not cutting rates is inflation. The U.S. inflation data rose 3.8% annually in April 2026. This is higher than the 3.3% we saw in March. The main drivers of this inflation are food and energy. Food prices went up by 0.5%, and energy prices jumped by 3.81%. This is a big problem for families trying to save money. Core inflation data, which excludes food and energy, is at 0.38% monthly. This suggests that services inflation is sticky and will not go away easily. The Federal Reserve noted an unprecedented rise in core PCE inflation from computer software and accessories. This specific category is contributing more than 2 percentage points to the overall inflation rate. This is very unusual because software prices usually go down. The Fed is worried that if they cut rates now, inflation will come back. They are in a tough spot. They need to keep rates high to stop inflation, but high rates hurt the economy. This is why the Fed is in favor of higher rates for now. Investors are watching these numbers because if inflation stays high, the stock market rally could stop. The Fed has said they will raise rates if inflation does not abate. This is a clear warning to the market. Now let's look at the geopolitical risks that are moving oil prices. While the US Fed is holding rates, the European Central Bank is facing its own problems. The ECB is dealing with persistent inflation pressures. There are energy risks coming from tensions in the Middle East. This is a big concern for Europe because they import a lot of energy. The June rate hike decision is looming. Markets are pricing in a 75% probability of a 25 percentage points increase. This means most investors expect the ECB to raise rates again. This is different from the U.S., where the Fed is not expected to cut rates soon. The ECB is in a similar situation to the Fed. They need to keep rates high to control inflation. If they cut rates too early, inflation could return. This global situation of high rates is making it harder for businesses to borrow money. It also makes it harder for people to buy houses. The housing market is feeling the impact of these high rates. Mortgage rates are high, which means fewer people can afford to buy homes. This slows down the economy. The ECB is watching the Middle East closely. If tensions escalate, energy prices will go up, which will make inflation worse. This is a low probability but high impact risk for the global economy. Investors need to watch the ECB meetings closely. Now let's look at the precious metals that are acting as a hedge. The world is very unstable right now. The global risk index is elevated. Tensions in the Middle East are impacting oil routes. There are ongoing negotiations for a 60-day ceasefire between the US and Iran. This ceasefire is on life support according to some reports. If the ceasefire collapses, oil prices could spike. If the deal is signed, prices might drop. The World Economic Forum 2020 geoeconomic confrontation and interstate conflict are the top risks. This is a serious warning for investors. Oil prices are currently at $72.4, but Brent is trading at $76.8. Oil is pressured by hopes for a ceasefire, but the underlying tensions are still there. The dollar is range-bound around 99.00. This is pinned between the stagflation-locked Fed policy and the pending US-Iran deal. If the deal is signed, the dollar might drop to 98.80. If the deal collapses, the dollar could rise to 99.50. This volatility is bad for businesses that trade globally. Investors are worried about a spreading of financial stress if conflicts get worse. The Iran World Cup roster finalization is happening amidst this drama. Markets are pricing in de-escalation, but we must be careful. Oil prices are near $100 again as Iran launches attacks. This shows how sensitive energy prices are to news. Now let's look at the crypto market and the massive outflows. Gold and silver are rising because investors are looking for a safe place to put their money. Gold is at $2,350, which is up 0.8% yesterday. Silver is at $29.8, which is up 1.2%. Precious metals are acting as a hedge against inflation and geopolitical uncertainty. Gold is breaking above the $2,340 resistance level. This is a technical sign that institutional investors are buying gold. They are moving money into this safe haven asset. Silver is outperforming gold because of industrial demand recovery. Silver is used in solar panels and electronics. As the economy grows, demand for silver goes up. There is also a monetary premium for silver. This means investors think silver is undervalued compared to gold. The gold-to-silver ratio is at 78-1. Lynn Alden says this signals that silver is undervalued. This is a good sign for silver investors, however. The crypto market is in a deep correction. Bitcoin is down 5.97%, and Ethereum is down 7.19%. This shows that investors are reducing risk in digital assets but buying physical metals. This is a smart move for protecting wealth. The Fear and Greed Index is at 11 out of 100, which is extreme fear. Historically, this is a contrarian buy signal. Investors should consider buying gold and silver when everyone is scared. Now let's summarize the key takeaways for your portfolio today. The crypto market is in a deep correction mode right now. Bitcoin is at $66,400, which is down 5.97%. Ethereum is at $1,850, down 7.19%. Solana is down 8.02%, and BNB is down 7.16%. This is a massive decline for the sector. The market cap of Bitcoin is $1.3 trillion. This is the third consecutive negative week for ETF outflows. There was a $1.7 billion weekly outflow. This is the second largest weekly outflow of 2026. BlackRock IBIT accounted for $440.3 million of the single-day outflow on June 1. This is a lot of money leaving the market. MicroStrategy broke their never-sell streak. They sold 32 Bitcoin for $2.5 million. This triggered a $15 million dispute resolution on Polymarket. Whale Alert detected large Bitcoin transfers to exchanges. This suggests potential selling pressure. 10,000 plus Bitcoin were moved in 48 hours. This is a sign that big investors are getting ready to sell. The Fear and Greed Index is at 11, which is extreme fear. Kevin warns of a short-term decline of 10 to 15% before the rally resumes. This is a decline from peak. Investors should be careful. The crypto market is diverging from the stock market. While stocks are up, crypto is down. This shows that investors are rotating out of digital assets. The CFTC cleared Coinbase to offer global crypto perpetual futures. This is a regulatory win, but it does not stop the price drop. Investors need to watch the outflows closely. Today was a day of extreme divergence in the financial markets. The stock market, led by the S&P 500 and Nasdaq, hit fresh record highs driven by the artificial intelligence boom. Companies like Nvidia and Marvell are leading the charge. However, the crypto market is in a deep correction. Bitcoin is down nearly 6%, and Ethereum is down over 7%. This split shows that investors are rotating out of digital assets and into traditional stocks. The Federal Reserve is keeping rates high at 3.63% because inflation is still at 3.8%. Core inflation is driven by food and energy prices. The ECB is also facing inflation risks from the Middle East. Gold and silver are rising as safe haven assets. Oil prices are volatile due to geopolitical tensions. Investors should watch the ETF outflows and the dollar index. The dollar is range-bound, around 99.00. The 10-year yield is at 4.46%. This environment is challenging for growth stocks, but good for bonds and metals. Investors need to be careful with their portfolios. Thanks for watching Market Pulse Daily.